It is Monday, 12 o'clock EST, and that means it's time for the real estate show, which is where we talk about everything to do with real estate so you can make some money, whether it's investing actively, passively. We've even talked about buying houses, anything to do with real estate. And today, interest rates. Are they good? Are they bad? What happens to the real estate market? What do you need to know about real estate interest rates? And this is basically going to be a masterclass. Everything you need to know about interest rates, how they impact you, how they impact real estate in general, how they impact your portfolio. I'm going to be breaking everything down and explaining some things you probably don't realize about interest rates, but how they can make a huge impact in terms of your profitability in your deal, but also how the market's going to react and how you can take advantage of that. So let's start at the very beginning, right? Because some people I have found don't understand what an interest rate actually is and how they are affected. Because we hear lots of stuff in the media, in the newspapers, on the news, and people just get the wrong impression. So basics, first things first, what is an interest rate? Well, whenever we borrow money from somebody, we're going to pay them interest or a certain percentage of a fee for the privilege of borrowing and using their money. So it's kind of like when you use a credit card, the bank extends you credit. You're using the bank's money to buy something, and for the privilege of doing so, oftentimes you're paying 19.999% interest using your credit card. Now, a mortgage or something like that, maybe you're paying 3%. 5%, 7%, 2.99%, whatever it is. So anytime you borrow money from the bank, you're going to pay them an interest percentage. Now, this is all laid out in the terms of the loan, and sometimes there's different types of payments. I'm going to get into that in just a little bit. But when we're talking about interest specific to real estate, what types of debt are you able to obtain for real estate? Well, there's going to be a couple. Number one is going to be a mortgage. So with the mortgage, I just messed that up, Robbie. So with the mortgage, the bank is going to loan. So let's say you buy a house. The bank is going to look at the value of that property, and they're going to loan you a percentage of that. So for instance, perhaps maybe this house is worth $1 million. The bank is going to give you 70%, so $700K, and then you have to come up with $300K. That's a mortgage. Now you're going to pay the bank interest every single month to pay for the privilege of borrowing the bank's money. The second way is called a HELOC in real estate. So this is a home equity line of credit. So I'm talking about if you own a house. What happens is people will own a house for a long time, and over the years, they're going to pay off their mortgage. So that means the value of the house, let's say the value of the house is $1 million, but maybe in terms of the debt, maybe they only have, $200K left on their mortgage. Well, that means they have $800,000 of equity sitting in their home that they can now leverage, and the bank will actually give them more money, so now they can go out and buy a second property, let's say. So a home equity line of credit allows you to tap into the equity in your home. So maybe you already have debt of $200K, maybe we'll take another $300K out in terms of HELOC. So now your total debt becomes $500K, but now you can take that $300K and buy a second property. That's what a lot of people do. And actually, I use that as well when I was doing single family home investing. Now, the third form of debt you often use or see in real estate is a line of credit. With a line of credit, oftentimes, it's going to be unsecured. If it's secured, it would be a home equity line of credit. If you're a business, you can get line of credits. There's different ways to get credit from the bank, but they're going to look at your revenue. If it's a business, they're going to look at your income. If you're an individual, and they're going to say, okay, I'm the bank. You seem to be bringing in X amount of money. These are your expenses. I'm comfortable extending you, giving you credit to draw upon $200,000 from me, and when you do so, when you use it, you're going to pay me interest, but if you don't use it at all, there's no fee. Perfect. The same thing applies with the home equity line of credit. So that's what you're going to be doing. Now, with debt, let me just do this. With debt, you can see with the mortgage and the home equity line of credit, it's what's called secured. So that means the bank is actually going to put something on the title of the property. They're going to secure it, because in case you run away and you never pay them and you flee the country, they're able to take that asset from you to make themselves whole. With the line of credit, sometimes they're secured, sometimes they're unsecured, which means there's no collateral. There's nothing given up in as security against the loan. Now, when we talk about interest rates, this is where a lot of people get confused about interest rates. So when we're talking about mortgage rates, you see all the time in the newspaper or on the news, people saying, oh, okay, the overnight rate, the Fed has changed the rate. Now interest rates are going to go down. Well, yes and no. So let me explain what I mean. You've got fixed rate, and then you've got variable mortgages. Let me explain exactly what these are. With the variable rate mortgage, this means that the percentage, the interest you're paying every single month to the lender, it will go up and down depending on what the market interest rate is at the time. So maybe when you start the mortgage, you're paying 3%, but then if interest rates go up over time, you could end up paying 5%. With the fixed rate mortgage, the interest rate that you're paying is fixed. It's steady. So you lock in for 5% for the next 20 years or 30 years, whatever, and it doesn't change. It is fixed. Now, there's pros and cons to both, right? So generally speaking, with looking at historic numbers, variable rate mortgages outperform fixed rate mortgages, but there's uncertainty. Because you could be paying X amount, and then all of a sudden rates go up. Oh, well, now all of a sudden you're not planning to have to shell out X number of dollars more every single month because rates went up. So that's why people like fixed, because they have that consistency. They know exactly what they have to pay every single month, and it doesn't vary. Now, where do these rates come from? And this is the big confusion that a lot of people have. So you'll see in the news, oh, well, the Fed, the Bank of Canada, depending on which country you're in, has changed the overnight rate. Okay, so let me explain what the overnight rate is. The overnight rate is set by the central bank, and it dictates how expensive money is for all the different banks operating to share money and owe each other money. It dictates how expensive the money is for those banks. So let me give you an example. If the central bank, the Fed, if they want to have money flow more freely, they will lower the overnight rate. What does that do? That makes money cheaper for all the banks, so the banks will start using more money because it's cheaper for them. But if they want to tighten things up and make money more expensive so money doesn't flow as freely, well, now they're going to raise the overnight rate, and now it's going to become more expensive for those banks to use each other's money. That's the 30,000-foot high-level overview of the overnight rate. Now, a lot of people think that when the overnight rate changes, so I see all the time, you look on social media, oh, the overnight rate went down, mortgage rate's going to drop. Yes and no. There's a lot of misconception here, because the overnight rate does not affect fixed rate mortgages. It does not. Fixed rate mortgages are influenced by the bond market, which is very different from the overnight rate. Okay, so when we're looking at mortgage rates, you have to understand what's influencing them. The bond market influences fixed rate mortgages, but if you have a variable rate mortgage and the overnight rate drops, well, now your cost of money is going to go down as well. Okay, so if you have a variable rate mortgage, The overnight rate, let's say it drops from 4% to 3.5%, or that would be pretty significant, but let's say, a quarter point, so from 4% to 3.75. Well, now you can celebrate because the cost of you borrowing that money has gone down because you have a variable rate mortgage that is governed or influenced by the overnight rate. If you have a fixed rate mortgage, you sign up, you know exactly what you're going to pay. It doesn't change and you're locked in. Whether the overnight rate goes up and down, it doesn't matter. But also when you're shopping for a fixed rate mortgage and you see, oh yeah, the variable rate's dropping, well, guess what? It's not going to impact your fixed rate mortgage. That's going to be influenced by the bond market. Okay, so that's the overview. That's the foundation. So you better understand what's happening with the interest rates and what's going into it. So now let me explain the benefits and the drawbacks of different types of rates and how they influence the real estate market. So let's first talk about low interest rates in the market, low rates. What happens when interest rates are low? So when the overnight lending rate is low, when the bond market has allowed those fixed rates to go down, what happens? Well, number one, we're going to have more affordability. Because if the cost of borrowing that money goes down, now people can afford to borrow more money for the same payment. And this is what happens in real estate, right? You've got these cycles. This is the real estate market. What happens is if more people are able to afford to borrow more money, they're able to invest more money in the real estate market. Now, what happens when more people are borrowing more money? Well, number one, there's going to be an upwards pressure on price. So prices are going to go up because now money is going to flow more freely. Okay, does that make sense? Now, when rates are high, money's not going to flow. Money's going to clam up because it's going to be more expensive. So now we're going to have reduced affordability. So what happens is, oh, well, now money's more expensive. Before I could have afforded a mortgage of $1 million, but now because rates went up for this exact same payment, I'm only able to get a mortgage for $800,000. So what's going to happen to prices? Well, money's going to tighten up now. People are not able to spend as much. So now there's going to be downward pressure on prices. So now obviously there's a lot more. This is very high level. There's a lot more that influences real estate markets. You got GDP growth, like there's a lot that goes into it. But at a very high level, again, speaking specifically about interest rates, you can see how if money's flowing freely and people are able to borrow more for the same price in terms of interest, they're going to borrow more. And then that allows them to spend more and get the larger house. But if rates go up, now money becomes more expensive. Now things tighten up. The market clams up, and now people have to watch their pennies, pinch their pennies, because the money is not flowing as free. Now there are risks and impacts and consequences to this happening. Okay, so when we have more affordability, so more people are able to spend more money in the real estate market, we have something called over leveraging. And this is what happens. So you can see right now in this graph. So, prices going up, then they're going to contract, and then they're going to go up again. This is the time in the marketplace where we have over leveraging. Because what happens is people at the top of the market, and the thing is with real estate market cycles, you never truly know when the peak of the market or the bottom of the market is, so you can never time the market, but you can get a rough idea for where you're at. And sometimes you're right, sometimes you're wrong. So that's why with real estate investing, you never time the market because you never really know what's going to happen in the future. Nobody has a crystal ball. But what happens is towards the top of the market, and we saw this happen with interest rates a couple of years ago, people end up acquiring these properties, these deals. And I'm going to use a couple apartment building investing examples. So people acquire these properties with a mortgage product that is more expensive. Now, it's called bridge debt, not to get into specifics, but it's more expensive for them to borrow. It's short term. It allows them to buy the property. Prices have gone up. They get the property with this expensive debt. But now what happens is the prices kind of go down. Rents go down. The price of the asset goes down. And now they're not able to roll from one type of debt into the other type of debt. Why? Well, because the rates were lower here, so they could afford to borrow more and acquire the asset for an X amount, but now the rates have gone up. Well, they're not able to afford this anymore because rates have gone up on them. They're not able to get different mortgage products, and now they're stuck. Now they have to sell at a massive loss, or there's the lender can take it over. There's a lot of things that can happen. So over leveraging is certainly a risk. And what happens when we have low rates and then the market surging? Lenders are going to be a little bit looser with their parameters. So maybe some lenders will let you borrow up to 90% of the value of the property, right? Because money's flowing freely. But what happens? Well, now when the price goes down, you have no more equity left in your property, and then you're upside down. And now we end up in a bad situation. So over leveraging can certainly happen. And also when money is flowing freely and people are borrowing more, we can get these inflated prices. So this is where the price goes up and then there's too much pressure. It's like a pressure cooker. Some pressure has to be released. Prices go down. The market stabilizes here, and then it's going to surpass the previous peak. And it always goes in the cyclical cycle. Now with high rates, right? The higher the interest rate, the less people can afford. Right? So what happens is when money's more expensive, there's less volume. So prices are going to go down. But also what happens is there's going to be less building, right? Because it takes money, it takes debt to develop and build new properties. So if you have a growing market that has people moving into it, and there's a demand for housing, but all of a sudden money becomes more expensive to get and banks aren't lending as much of it, people are going to stop their building projects. What is the impact? Well, the long-term impact, and this is where we get that market cycle again, the long-term impact is we have all this population moving in, nobody's building. So now we have the same number of units available for a growing population. Nobody's building because money's too expensive and too hard to get. What pressure does that put on the housing supply in the long term? Well, prices are going to skyrocket because nobody's building anymore. They can't afford to build, but we still have people moving into the marketplace. So high rates, yes, it makes it more expensive. Prices go down, but also in the future, it almost ensures that prices are going to go up because we're now no longer meeting the demand for housing in that marketplace because money's now too expensive. Okay, so now there's going to be a pent-up demand, and as soon as those interest rates drop down, all of these people more people are going to compete for the same number of housing units. And what happens when you have a lot of people wanting not a lot of stuff? Well, prices go up, right? So that's what happens when interest rates go up. Now, obviously, like I said in the previous example, interest rates go up. People who over leveraged, so they took on too much debt, because remember, debt is a double-edged sword. When things are going good, it can make it go really, really good. But when things are going bad, it can make it go really, really, really bad. It's a double-edged sword. And so when you borrow too much or you're risky with it, if you're not buying the right type of property that can support the debt, well, now you can get yourself into trouble. Okay, but yeah, 100%. The less building part, that is a concern. I live in a major metropolitan area where there is a housing shortage, and when interest rates go up and it's harder to get money, well, that demand, it doesn't go away. People are still moving in. People are still having kids. Immigration still happens. It's not going away. It's just setting yourself up in the future for this massive price surge as soon as interest rates go down. Okay. So those are the things you have to know about interest rates and real estate, right? So at this point, we've talked about interest rates, what they really are, what impacts those interest rates, fixed and variable rates, and what influences those rates is not always the overnight rate. We've talked about low rates. We've talked about high rates. We've talked about the cost of borrowing. We've talked about what happens with over leveraged situations. We've talked about the different types of debt you can get with real estate. So mortgages, lines of credit, HELOCs, and then how you can use it. Okay. So before we end this video, I just want to share with you how debt, how interest rates, how getting a mortgage in real estate can impact you. Okay. So this is how the richest people use debt to get exceptionally wealthy in real estate. And I'm going to use big round numbers just to make this easy. Let's say you buy a property and you buy it for $1 million. And you go to the bank and you say, Mr. and Mrs. Banker, I have this piece of real estate. I want to get a mortgage that we talked about for this piece of property. And I'm asking for $500K in debt. So that means you have to put up $500K in cash. And again, like you can do 80-20. There's so many different things. I just want to keep this simple. Let's say you hold that property for 10 years. Now, a rule of thumb is prices of real estate, property values double every 10 years or so. Sometimes it's every 8 years, sometimes it's 12 years, but generally speaking, every 10 years. So that property goes from $1 million to being worth $2 million. Great. Now you've got this debt. This debt isn't going to change. Well, actually, it's going to go down if you do interest P&I payments, but I'm not going to get into that. Let's just assume you're paying the interest only. That debt over the next 10 years is going to stay at $500K. But look at your equity. That property is worth $2 million now. That debt, it stays at 500. But now your equity, instead of 500K, that property was worth $2 million. So we take 2 million, subtract 500K. Now you've got $1.5 million of equity in the deal. Imagine doing that over 10 properties or 20 properties or 5 properties, 3 properties. This is how the rich people use debt. A lot of people are scared of debt. Oh, no, you shouldn't borrow money. Well, when you're buying solid pieces of real estate, you're not over leveraging, you have a solid plan, right? You have a business plan, and you buy a great piece of real estate and you put responsible debt on it and you hold it for the long term, you will make money. That's just the way it goes. But where people get in trouble is they borrow too much, they get the wrong asset. Like there's all these things that they do wrong. But if you buy a solid asset and you hold it for the long term, 10 years, just look, like it's property prices double every 10 years. So you go from $1 million to $2 million. Your debt stays the same. And now your equity has gone up. And so you've turned $500K into $1.5 million. Not bad in 10 years. That's how the richest people get rich, owning real estate. All right. So I hope this made a lot of sense. And if you're interested in learning more about apartment building investing, which is this type of stuff that we do here with CPI and with myself, go to theapartmentaccelerator.com. Check it out. We can actually help you get into your first apartment building deal. And we've got a whole bunch of resources for you there. So theapartmentaccelerator.com. Go check it out. And I'll see you next Monday on The Real Estate Show.